Welcome and thank you for joining. My name is Gina Buchholz. I'm one of the advisors at 401k Plan Professionals. And on behalf of our team, there's our team, Jenna, Jessica, myself, and Virginia. We're excited to do this presentation. It's a little bit different than some of our past webinars about investing and investing behaviors. So I appreciate you joining today. Just a quick reminder about our webinar series. We're actually hosting 14 webinars this year. We've done Medicare, Social Security, a lot of other webinars. All of those webinars are recorded, so keep that in mind. You can always find them on our website at 401kplanprofessionals.com or our YouTube channel. If you can't find the past webinars and you are looking for a recording, you can, of course, always reach out to our team. I am more than happy to email you the recording as well. So feel free to share that with friends, family, staff, anyone. These are available to the public. So keep that in mind. There's our YouTube channel. Again, a lot of great information out there and also on our website at 401kplanprofessionals.com. A little bit about me. I'm not going to read my bio, but there's a little bit about me. I've been in the industry actually my entire adult life. I studied finance in college. I worked for financial services companies after I graduated from college. And I've been an advisor for over 15 years. I love what I do, and I love the education piece of what I do. When I talk about how many years I've been in the industry, that either means I'm really old or it gives me a historical perspective. So you can look at that either way. But I'm excited to do this. A lot of great information to share today. Keep in mind, if you have any questions, please feel free to put that in the Q&A. I will probably not get to most of the questions. I'll keep my eye on it, but I'll probably get to the questions towards the end of the presentation. But here's what we're talking about. My brain made me do it. We're going to be talking about strategies to help you make better investing decisions. We're going to investigate how we make investment decisions and just understand how sometimes our thought process leads to common investment mistakes. We're actually going to talk about 6 common investing mistakes that people tend to make. And I hope throughout the presentation help you train your brain to avoid those mistakes. I think what you're going to find in this presentation is it is a little bit about history, because history has taught us a lot about the financial markets. It's a little bit about economics, and it's a little bit about psychology, all rolled into one. So you might feel like you're going back to high school, history class, finance, economics, but I hope you find it fun. Again, this is a pretty unique presentation that we put together for you today. So quick question. One of the most fundamental principles of investing is you buy low and you sell high. Really simple, right? We know that reflectively. We do know that buying low and selling high is what we should do. But I want you to pause for a second and think, have there ever been times where you were enticed to do just the opposite? Think about when there was a market downturn, whether that was the recession of '08 or maybe during the pandemic. Did you ever feel like selling something when the market was low? If you have, I've felt the same way. Have you ever had that inclination to buy something when the price was high? Maybe your neighbor or your friend is talking about what a great investment gold is. But when you start to look at gold prices, you realize, gosh, this probably isn't the best time to buy gold. It's trading at a really high price. So I think we've all probably felt that inclination, whether it was buying high or selling low, just the opposite of what we should do. So what we're going to talk about today are 2 schools of thought. Intuitive is those quick emotions. It's decisions that we make on a gut feeling. These are quick decisions. Again, they're oftentimes based on emotion. And what we want to change is that thinking to be more reflective. And if you can see the gentleman in this presentation, I think he is in some deep reflective thought. Reflective means we pause, we think more methodically, and we apply logic and data to make a good decision. So sometimes when we stop and pause, we're going to make a better decision. So we're going to try to take that emotion out and change that intuitive thinking to reflective thinking. So we're going to talk a little bit about throughout the presentation. But here are the 6 common mistakes that we see people make in investing: loss aversion, anchoring, status quo bias, procrastination, hindsight bias, and availability. Some of these I'm going to spend a little bit more time on than others, but we're going to begin with loss aversion. So loss aversion is people's tendency to strongly prefer avoiding losses over acquiring gains. There is some psychological data that shows a loss can be twice as powerful as the impact of a gain. Now, I already mentioned I've been in this industry for a long time, and I can tell you that that is definitely true. When there's times of market volatility and there's market downturn, we get a lot of phone calls. People are fearful. They're not sure what they should do. I rarely get a phone call when the market's up. People calling me saying, "Hey, Gina, my 401k account is way up today. This is awesome." It's really the fear that we hear. And that's very normal. So here's a couple of signs that might lead me to believe that you're having some loss aversion. I can't sell now. It's down too far. It will come back eventually. I don't mind staying in cash. The markets have been crazy lately. I'd rather keep it safe. Those are some signs that you maybe are dealing with some loss aversion. Now, this is a slide I'm going to show maybe later on in the presentation as well, but it's one of my favorite slides because it does give us that historical perspective. And yes, there have been times of loss. This is what the stock market has done since 1997 through the end of June this year. And certainly, we've had times where the market went down. The dot-com bubble, the recession of '08, this is the pandemic. There was a market correction in 2022. And even earlier this year, we felt a big dip in the market when we were talking about tariffs and trade negotiations. I actually was doing a presentation for a group of high schoolers yesterday, and I showed them this picture. And I said, "What does this picture tell you?" And they all were like, "The stock market goes up." Well, it doesn't really feel like that, right? When you're in the middle of the pandemic or a recession. But yes, over time, we've been very fortunate. The market has recovered, and over a long period of time, it has gone up. So a couple of financial decisions that are driven by loss aversion: reluctance to sell losing investments, selling winning investments too early, excessive risk aversion. We're going to talk about this later. By taking no risk, people don't understand sometimes that there is a risk. Putting that money under a mattress, you're going to incur inflationary risk. We'll talk about that later. And inaction bias. That just means you're sort of paralyzed by fear and you don't take any action at all. Quick story when it comes to selling winning investments too early, because I heard this great story. It was actually from my son about a month ago. He was working, he's out of college, he's very young. He works for a financial office, a financial advisory office in St. Louis, Missouri. And they had a client walk in the door. This was a gentleman, he was in his 60s, and he was carrying 2 paper stock certificates. Okay, right there, that's pretty unusual. We haven't issued paper stock certificates since like the 1990s. So my son at least knew that these stocks he had probably bought long, long ago. And he held 2 Berkshire Hathaway paper stock certificates. And if you're not familiar with Berkshire Hathaway, that is the company that Warren Buffett started over 50 years ago. And my son, very inquisitive, said, "When did you buy those stocks?" And he said, "Well, in 1984, I read an article about Warren Buffett and I bought a share of stock. I bought it for $1,352. And then in 1992, again, that was 1984. In 1992, I bought a second share of Berkshire Hathaway stock and I just held them." He also went on to tell my son that him and his wife lived very modestly. They worked really hard, they saved really hard, and they raised 5 children. Today, one share of that original Berkshire Hathaway stock is worth over $700,000. He has two. So he's carrying around $1.4 million. And he didn't come to sell them, he came to deposit them into his brokerage account. But I would like to ask you, how many of us throughout his life, raising all of these children, living very modestly, would have been tempted to sell that stock when it doubled, when it was trading 10 times its original value? It's trading 500 times the original value, and he never sold it. So just kind of a cool story. And I do like Warren Buffett. He has dispensed many words of wisdom. I will probably mention his name a few other times. But back to loss aversion. One of the things that we should always remind ourselves when there's a market downturn or even a recession is the benefit of dollar cost averaging. This is an opportunity to buy in planned intervals, like you do in your 401k, and it forces you to buy when prices are low. So whether you know it or not, when the market goes down, if you're saving and investing in your 401k, it gives you that opportunity to buy low. And remember one of the first slides we went back to, you want to buy low, right? So let me give you a quick example in terms of dollars and cents of how dollar cost averaging works. Let's say you have $3,000 to invest in the market and you decide, I'm going to spread that out and invest $250 every month. Let's say in January, the share price of the investment that you're going to buy is $20. That means you get to buy 12.5 shares. Well, during the year, kind of like this year, the market dropped. So the share price is now $16. Ooh, that doesn't feel very good, right? But I'm still buying. I'm buying low. And my $250 actually allows me to buy over 15 shares because it's cheap. It's on sale. I get to buy more. At the end of the year, the market recovers and the share price is back to $20. In this example, because I had this opportunity to buy during the dip, my $3,000 is actually worth $3,339 for an investment gain. But think about this. If I took that $3,000 and bought it on January 1st, put it all in the market on January 1st at $20, a year later, it's still worth $20 and I had no investment gain. So just a quick recap, you invested $3,000, you had an opportunity to buy during the year when the market dipped, and it's worth $3,339. That gives you an 11.3% gain when you use dollar cost averaging. If I didn't use dollar cost averaging in that example, I would have had no gain at all. So again, remind yourself sometimes when the market's low, that's where there's an opportunity, and continue to buy, continue to invest, and continue to save. So a couple things about loss aversion. Don't just prepare for market volatility, expect it. We have seen a lot of market volatility in the last 5 years. Obviously, in the last several decades, you have to expect it. Involve impartial people, whether that's your financial advisor, whether that's us, maybe it's your accountant, maybe it's a family, maybe it's someone in your family who's very knowledgeable that you trust. But involve some other people to talk through this decision making. Create a disciplined plan and stick to it. Also, make sure you have an emergency fund. That's very comforting to know, okay, the market went down, my account is worth less today, but it's okay. I have some safe money over here in my emergency fund. I can still pay my bills. I'm still going to be okay, and I can let the money that I have in the market come back up. And of course, establish that dollar cost averaging plan. If you are contributing to your 401k, you are doing dollar cost averaging. Just stick to it. So that was loss aversion. So again, dollar cost averaging is really an important concept to remember. Another one we're going to talk about is anchoring. So anchoring is this human tendency to rely too heavily on a past experience or a piece of information. Now, again, as I said, historically, we can learn things from history, right? But we don't want to. But we don't want to overreact to what has happened to us in the past. A great example of anchors is the Great Depression of 1930s. Now, of course, I know most of you on this call probably didn't live through the Great Depression, but my grandmother did. And I do vividly remember her talking about the only thing that grew during the 1930s was my dad. They were farmers, their crops didn't grow, and their bank accounts certainly didn't grow either. But if you know anyone who grew up during the Great Depression, you probably know that they have fostered this sense of frugality. They're very frugal. They've put an emphasis on self-sufficiency, and they tend to avoid debt. Now, some of those characteristics are not bad, but this was also the generation that put their money under the mattress. If you've ever heard that term, it probably started with people from the Great Depression. They didn't trust banks. They didn't trust financial institutions. And think about if you put your money in your mattress in the 1930s, it's probably lost some purchasing power. So, as I mentioned earlier, avoiding that risk, um, they incurred inflation risk, right? That money's not certainly going to buy um, what it did in the 1930s. So, you don't want to be overly cautious or overly conservative. There's certainly some other examples of anchors, and you might remember some of these. I definitely remember some of these, not necessarily the market crash of the 1970s. I was pretty young, but I do remember the inflation of the 1980s. At least I remember my parents talking about it. I remember the dot-com bubble, the Great Recession of '08. Now I'm probably talking about things that resonate with you. And of course, the pandemic in March of 2020. So those are some common anchors. So the dot-com bubble, I was pretty early in my career when this happened. So the dot-com bubble was internet companies were becoming very, very profitable. The problem was a lot of those internet companies, dot-com companies, if you really looked into their financials, they didn't have the business structure or business strategy or business plan or profitability to support their stock price. And eventually, a lot of those initial internet companies went out of business. It was also about this time that you might remember a company called Enron. If I could see you, I would like to see some of you nodding if you remember Enron. The one good thing that happened through the dot-com bubble is we scrutinized financial statements more. And Enron, if you can believe it, it was one of the largest companies in the S&P 500. So one of the largest companies in the US. So it was kind of like Apple, Amazon, Microsoft. It was that big. And everybody was investing in Enron. So much so, the Enron employees, they even had Enron stock in their 401k, and a lot of it. Well, unfortunately, their stock price was based on a lot of fraud, a lot of misrepresentations, and eventually Enron, there was a whistleblower, Enron went bankrupt, and a lot of the executives went to prison. And one thing I remember distinctly about that is somebody asked Warren Buffett, why aren't you investing in Enron? This was at the height when everybody was investing in Enron. And he said, I don't understand their financials. And I always remember he said, don't invest in something you don't understand. So that resonates even today. So we also had the Great Recession of '08. This one really stuck with me. I think if there was any period of time that really probably rattled my confidence, it was this recession because financial institutions, some of the largest financial institutions in the US, were really starting to crumble because of the credit crisis. And the only reason they stayed solvent was because the government had to intervene. So that was really unusual, and it took 58 months, almost 5 years, for us to completely recover from the recession. We didn't really fully recover from that until 2013. So that was deep and that was long. And then, of course, many of you remember COVID-19. I'm sure all of you do. And that was just something that a global pandemic we hadn't experienced, unless, of course, you lived in 1970, 1917, and that was the Spanish flu. That was the last pandemic we had. So most of us had never experienced anything like a global pandemic to that extent. So very nerve-wracking. But those are some anchors that people tend to hang on to, good, bad, or otherwise. And a couple things to remember. This is historically the stock market, and many years it's been up, and sometimes during that year it's even been down. This year is a prime example. This year, earlier first quarter, the market was down negative 19%. That's pretty significant because of tariffs. But if you just held on, remember, buy low. The market has recovered. At the end of Q2, it was up 5%. Today, the market has actually recovered. The S&P is up over 10% year to date 2025. But again, we look back and there's always periods of time during most years where the market's going to decline. So again, don't just prepare for it, expect it, it's going to happen. The next couple of slides, I think you might find kind of fascinating. Another thing to keep in perspective, if we look back 97 years from 1928 to 2024, 71 of those years were positive. So that's 73% of those years were positive, 26 of those years were negative. And look, 21 times, 21 years, the market actually returned between 10 and 20%. Wow, a double-digit return. 18 of those years, the market returned 20% to 30%. So pretty significant. So keep in mind, most years have been positive, at least 73% of the time. And then you probably know that if you're going to hold stocks, stocks should be held, especially if you have a longer time horizon, like in your retirement plan. So let's change that a little bit and look back at rolling 10-year periods, starting from 1928. So looking at all of these rolling periods, 10-year periods, now you have 83 positive times, 94% of the time. If you hold that for 10 years, at the end of that 10-year, you're going to have a positive return. The only periods in history where a 10-year period ended negative were during the Great Depression and during the Great Recession. So the 1930s and 2008, 2009. Every other rolling 10-year period in history ended positive. So again, keep that in mind too. The longer time horizon I have, the better opportunity I have to get a positive return. So a couple things when we talk about anchoring, I'm still down 10%. I just want to get back where I started. I've thought that before. 6 months ago, I had X. Now I have half of that. So again, those are some things that might tell you maybe you're stuck in the past. Keep an open mind. Seek out this information to give you perspective. Change your anchors. And one of the most important things that I think you can do is remind yourself there's some things we can't control. We can't control a lot of the things that go on in the economy. We can't control the stock market. But some things that I can control, how much am I contributing to my 401k? How much do I have in my emergency savings? So those are some goals that you can make sure that you have and make sure that you can control. So that's a little bit about anchoring. Next couple, I'll go through these two a little bit more quickly. Status quo bias. It's easier to do nothing. We're creatures of routine. And also procrastination. So status quo bias. Gosh, I've held that investment for years. It's been good. No need to change it now. More than half of my portfolio is invested in company stock. I heard that's not such a good idea, but I don't know where else to go. I don't know what to invest in. So those are some things that might remind you that you're just staying in the status quo. Now, keep in mind when we pick our initial investment allocation, I probably picked mine back in my 20s. You probably did too. What was good for me back in the night when I was in my 20s might not be appropriate for me today. It's just like I probably shouldn't eat like I did in my 20s. I probably wouldn't. I ate a lot of pizza, other things that probably weren't great for me. So my investment allocation that I picked 20, 30 years ago, I probably need to look at it, right? We know as we get older and closer to retirement, we need to change our investment allocation. That's what our team is here to help you with. We're always available if you have any questions at all, if you want to look at your investment allocation. But again, you might need to change it. That investment allocation should align with your risk tolerance and your age and your goals of retirement. The other thing you need to remember is you might need to rebalance that from time to time. So this is a typical allocation of someone who might be approaching retirement. That you have 40% in bonds or fixed income, so that's safer in type of investments, not subject to market risk, and you might want 60% in stocks. But sometimes if you're not paying attention, especially this happened during the recession, before the recession of '08, the market was doing really well, and people approaching retirement found that maybe they had 70, 80, even 90% in stocks. Well, they forgot to rebalance. That was too much in stocks. They subjected themselves to too much risk, and then the stock market dropped 60% right before they were going to retire. Those people forgot to rebalance their portfolios. So that is an important thing to remember to do. So again, check in with us to make sure that investment allocation is appropriate. We can help you rebalance if need be. Many people use target date models. Those are great because those investment managers are going to rebalance automatically for you. And that target date model is going to change to become less risky as you get closer to retirement. Believe it or not, those target date models became very, very popular after the recession of '08. People were looking for somebody to watch out for their investment portfolio, and those target date models do it for you. Again, if you're not in a target date model, make sure you're watching those investments and rebalancing them. Procrastination, we all know what procrastination is. It's a positive bias towards the present and also maybe even anxiety starting a complex task. So here's some popular things I hear. I really should join my company's retirement plan. I'll get to it next week. Our child just turned 10. We really should open a 529 account one of these days. I get it more than anybody. We're all busy. We're all working hard. We get home at night and we're pulled in a million different directions. It's hard to sit down and focus on this. So keep that in mind and make a schedule. Revisit your plan on a regular intervals. Involve others and hold yourself accountable. Learn what motivates you. And again, reward yourself for progress towards those goals. But again, just having a schedule, if it's meeting with us or your financial advisor once a year, great. Twice a year, that's fine. Maybe more often as you're getting closer to retirement. We're here to help you. Again, involve others, whether that's an advisor, a trusted person in your family, your accountant, but those people will hold you accountable too. Couple last mistakes we're going to talk about. Hindsight bias, and then we're going to talk about availability. So hindsight bias is taking action after it's too late. I love this. It's why people start to eat right and exercise after maybe they have a heart attack or a health scare, right? It's knowing that it's regretting I should have done things differently years ago. We can't live in regret, but there's a couple of things about our emotions we should understand. And if we look back in history, when it comes to our financial life, we have all probably felt this emotional roller coaster. So you're feeling confident. The market's good. You've made some money. Your 401k account keeps going up. Your savings account keeps building. You start to feel euphoric. I know I do feel euphoric when I look at my 401k and it looks bigger. I also feel euphoric when I get our property value for our home. You guys probably know what I'm talking about. Every year you get sent your property value. The last several years, many people, their home prices have increased. So if my 401k looks big and my home's worth a lot more, I kind of feel rich. This is the riskiest time. I know I can't cash out my 401k and I'm not going to sell my house, but I just feel more rich. My net worth has gone up. And this is the riskiest time. And this is sometimes when people spend too much or live outside their means. So that euphoric feeling, be really careful because we know the market's going to change. And when it starts to dip down, we start to feel nervous, we start to feel desperate, and then you just feel darn defeated, right? When that value of your home goes down, the value of your 401k has dropped, I've depleted my savings account, but this is oftentimes the best time to make money. So I'm sure we've all rode those emotions when it comes to our investments and our financial life. Again, I'm going to show you this one more time, and I want you to look at this really closely because I want you to think of to yourself, if we can look back hindsight, again, we're talking about hindsight bias. If we had this crystal ball, if we knew what the market was going to do, when were some times in history we should have bought more? Think about that. Here, 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 and even earlier this year, right? We actually should have been buying more. Okay, brace yourself. What did Americans do? They did just the opposite. Look at this slide. Millions and millions of Americans did just the opposite of what we know we should do. During the financial crisis of '08, this is a graph. It shows the market, the ups and downs. This is investors leaving the market. They're selling when the market's low. We don't want to sell when the market's low. We want to sell when it's high. And then guess what happened? Remember I told you the recession of '08? It took about 58 months to recover. So in 2013, look at all the people who got back in the market. We should have been buying down here. We should have let it grow and accumulate and appreciate in value, but it is the exact opposite of what people did. Same thing during the pandemic. People panicked. There was fear, and people sold out of the market here, and they waited until the market recovered, and that's when they bought back in the market. Again, if you did it, it's okay. Don't beat yourself up. We can't change what you did. But again, millions and millions of Americans did the exact same thing. So I love this slide. This is a slide that JP Morgan sent fairly recently, and it shows from 20 years ago, July of 2005 to June 30th of 2025, if you would have invested $10,000, that $10,000, had you stayed fully invested in the market, would be worth $66,737. So in that 20-year period, if I would have plunked $10,000 in July of 2005, this is what it would be worth today. That averaged a 10% average rate of return. But if I would have missed the 10 best days in the market, look how much less I would have had. Just the 10 best days in that 20-year period. The other thing that we have realized in the recession of '08 and during the pandemic, sometimes the very worst days are followed within a day or two or a week of some of the best days in the market. So sometimes we hear really, really bad news and the market dropped a lot. But during those periods, it was just a couple of days later where we saw some of the biggest gains in the market. But I think that's really astonishing. Also, just how money can grow and compound in that 10-year period, but also knowing that, if you move your money at the wrong time, you could lose on some of the best days. So interesting data. And again, also remember that bull markets tend to last longer, and we've had more of them in the last 70 years. So the green shows are bull markets. That's when the market's going up, and the blue shows when the market goes down. And up here, some additional data. We've had 14 bull markets in that 70-year period. We've had 13 bear markets. But here's what's interesting. The bull markets have lasted 53 months, and the bear markets have lasted on average 13 months. This is the average return of a bull market. This is the average return of the bear market. So again, we definitely have had more bull markets where the market's going up than we have had down markets. So keep that in mind. And then this one last slide just to share why we invest long-term if we're investing for retirement. This green bar shows stocks. And since 1950, if you only had 1 year to invest, you probably shouldn't invest in stocks. Should not invest in stocks. You don't want to invest a lot of the money that you're going to need next year in stocks. You could get lucky. The best 1 year period we've had in stocks was up 52%, but the worst year we had in stocks was negative 37%. So if we had a really bad year and you need this money next year, that wouldn't be great, right? You don't want to put short-term money that you need in the short term in stocks. But if we look out over the rolling 20-year period, you can see stocks have outperformed bonds and even a balanced portfolio. If you had a 20-year period, the best 20-year period ended with an average return of 18%. Even the worst 20-year period, you still had a positive return of 6%. Again, just reminding us the longer time horizon you have, the more stocks make sense. So, of course, hindsight bias, I don't care what happens next. I'm moving to cash until things calm down. And the market has done great this year. I knew I should have invested more. So, just having that regret. Don't have that regret. Remember, you did the best you could with the information you had. Make sure you still have that plan and keep that long-term perspective. And even write yourself a letter. I love this. My financial advisor and I have established a long-term plan. I know the market's going to correct at some point. I'm going to feel uncomfortable, but you know, stay with that sound plan. If anything, remember those market downturns might be a good time to buy, and my long-term goals haven't changed, and I'm going to stay consistent and stick with that long-term plan. So sometimes, when the market's good, like today, it's a good time to remind yourself that you have a long-term plan, you're invested appropriately, you've got money in cash, you've got emergency savings, you're going to be okay if the market goes down. Last mistake. I know we're a little over our 30-minute time frame, but this is one of my favorite ones because we are bombarded by data in the media. Availability. It's the presence of media coverage. We're hearing things on social media. We're hearing things on the news. We're constantly scrolling on our phone, and you want to be careful about what you hear. I see people with iPads everywhere. Apple must be a good stock to own. This guy on TV says now's a great time to buy gold. He must be right. He's on TV. Here's a great example. I don't know if you guys remember a couple years ago, Tom Brady, Shaq, Steph Curry, they were promoting a stock, a company, a cryptocurrency exchange called FTX. FTX, the founder was named Sam Bankman-Fried. Sorry, I got his name wrong. And it was going up, and celebrities were buying it, and everybody was buying it. And unfortunately, that was also a company that was riddled with fraud. Sam Bankman-Fried is now in jail, and it's reported that Tom Brady lost $30 million. I'm not sure if that's allegedly, but I do know he lost a lot of money. But we have all of these celebrities telling us we need to get into cryptocurrency. We need to buy FTX. And obviously, that was very, very misleading. Many people lost money. So again, do your research, apply that reflective thinking, use data and logic before you buy something. But again, we're bombarded with that. And also evidenced by, people ask me all the time, should I buy cryptocurrency? Should I buy gold? Be really careful. Again, don't buy things that you don't understand. And I'm going to leave you with these last couple words and also my favorite quote from Warren Buffett. But availability. Don't believe everything you hear. Bad news sells newspapers. Even experts, your neighbors and your friends can be wrong. And systematically investing works in up markets and down markets. So my last quote from Warren Buffett, he said, "No one wants to get rich slow." And that couldn't be more true. Again, people are always looking to buy in, the newest thing, the best investment, how they're neighbors made money. But the reality is, most of the people in this world who've accumulated wealth or even just achieved a really sound and comfortable financial retirement, they did it slowly over time. They probably did exactly what you do. You save every paycheck, you have a plan, you stick to it. You have an emergency savings fund, you're diligent, you don't cash out your 401k, you don't borrow from it, you just continue to invest and save slowly over time. And that is how most people have created wealth in this country. So don't be enticed by some of those headlines that you might have heard. Don't try to get rich quick because oftentimes that comes with undue risk. So again, just a couple of strategies to consider. Write down your plan, refer back to it, establish some steps that you can control, and establish those steps, before you're in a crisis. Remember to dollar cost averaging, save in your 401k. Expect markets to go down. They will, and make appointments with your financial professional. And that, again, is where we're here to help. So I hope we have helped you to program, to think more reflectively, to have a new mindset, and remember to have a plan and employ people that you trust. Here's our contact information. You can reach out to any of us. You can use that QR code if you want to schedule an office hour. We do virtual office hours. You can use our website to schedule that, or again, use our QR code, or just simply give us a call or zip us an email. Also, quick reminder, we've had a ton of webinars this year in 2025. A couple popular ones were Social Security and Medicare. We also, in November, have our 8 steps to becoming financially well. I'm really looking for forward to that one too. So you can register for those here with our QR code and also out on our website. So again, I want to thank everyone for joining us today. I'm just going to check here real quick to see if we have some questions, and I'm going to take a look here. Interested in transitioning retirement income. Oh, very good. Okay, so again, if you're approaching retirement and you're looking to see how you're going to change what you've accumulated to retirement income, reach out to us. We can share some ideas and some strategies to do that. Also, somebody mentioned, if you're not in the target date fund, you want to look at your investment portfolio and rebalance. Example, let's say you want to be 80% in stocks, 20% in fixed income. Many of the record keepers that you use, the website portal that you go to, or even the mobile app that you have, there is a rebalancing feature. So, whether your 401k is through Empower, Principal, Fidelity, go to your website, look under the investment tab, and you should be able to find a rebalancing button. And that's going to rebalance, in that example, your portfolio back to an 80-20 or 60-40 mix. If you're not sure how to do it, please call us. We can walk you through how to do the rebalance. But again, there is a rebalance feature on almost all of your 401k websites and mobile apps. And last question, how often should I review my portfolio if I am 60? I would say at least once a year. Make sure you review that investment portfolio. As you're starting to approach retirement, I would definitely meet with your financial advisor or us every year, for sure, just to make sure you're on track. And I would say, again, rebalancing is recommended. You can pick your frequency. I think semi-annually or annually is just fine. You can pick a frequency that's quarterly, semi-annually, or annually. So that means they're going to rebalance. They're going to do those trades to rebalance on one of those whatever frequency you pick, and you can change that frequency if you want. You can pick quarterly, semi-annual, and annual. I do mine semi-annually, just a personal preference. But again, you can pick your frequency, but should be one of those: quarterly, semi-annual, or annually. Great questions, everyone. Yeah, thank you. For those of you who need to hop off, again, thank you for joining today. Really appreciate it. I'll check and make sure that uh, there's any other questions, stay on. I'm happy to stay on. And again, remember just to reach out to our team. Happy to schedule those one-on-ones. I'm going to land right there. So as you're hopping off, you have our contact information. Have a great day. Thanks for joining.